Socially responsible investing, SRI, is a powerful way to grow your wealth while making a positive impact on the world. By aligning your investments with your personal values, SRI allows you to support companies that prioritize environmental sustainability, social justice, and ethical governance. From clean energy initiatives to diversity-driven enterprises, socially responsible investing is more than a financial strategy. It's a statement about the future you want to help create. Today, we will talk about socially responsible investing, aligning your money with your values. So before we start, make sure to hit the like button and subscribe to my channel. What is socially responsible investing, SRI? Socially responsible investing involves selecting investments based on ethical, social, and environmental criteria, in addition to traditional financial considerations. The goal is to balance financial performance with positive contributions to society and the planet. SRI often incorporates a set of principles, such as environmental sustainability, supporting companies that focus on renewable energy, waste reduction, or conservation efforts. Social responsibility, investing in businesses that champion fair labor practices, diversity, human rights, and community development. Ethical governance, favoring organizations with transparent practices, anti-corruption policies, and strong corporate governance. Unlike traditional investing, where the primary focus is maximizing returns, SRI emphasizes both profit and purpose, making it a cornerstone of ethical finance. How socially responsible investing works. Screening investments. SRI uses two primary types of screening to select suitable investments. Negative screening, excluding companies or industries that conflict with certain values. For example, investors might avoid sectors like tobacco, weapons, fossil fuels, or companies with poor human rights records. Positive screening, actively seeking out businesses or funds that demonstrate strong environmental, social, and governance. ESG practices. This might include firms developing clean energy technologies or promoting workplace equality. ESG integration, environmental, social, and governance. ESG criteria are central to SRI. These metrics provide a standardized way to evaluate a company's impact. Environmental, assessing carbon footprints, energy efficiency, and ecological conservation. Social, examining employee relations, community involvement, and supply chain ethics. Governance, evaluating executive compensation, shareholder rights, and board diversity. Shareholder activism. SRI often extends beyond stock selection to include shareholder activism. Investors use their stake in a company to influence corporate decisions, advocating for ethical practices and greater accountability. This might involve voting on resolutions, engaging in dialogue with management, or filing proposals to drive change. Impact investing. Impact investing is a subset of SRI that focuses on generating measurable positive outcomes alongside financial returns. This approach directly targets issues like poverty alleviation, education access, and clean water initiatives, often through ventures or funds that tackle these challenges head-on. Why is socially responsible investing popular? SRI has seen exponential growth over the past decade, fueled by a combination of cultural, generational, and financial factors. Growing awareness of global challenges. Issues like climate change, income inequality, and corporate ethics have gained prominence, leading investors to seek ways to address these problems through their portfolios. Generational shifts in investment preferences. Millennials and Gen Z investors, in particular, are driving demand for SRI. These generations prioritize purpose-driven decisions, viewing investment as a tool for creating social and environmental change. Competitive returns. Contrary to the perception that ethical investing sacrifices profits, research shows that companies with strong ESG practices often outperform their peers over the long term. Their focus on sustainability, efficient resource use, and employee satisfaction translates into lower risks and greater resilience. Accessibility of SRI funds. The rise of ESG-focused mutual funds, ETFs, and robo-advisors has made SRI more accessible to individual investors. Platforms now offer curated portfolios aligned with specific values, enabling even beginners to participate in socially responsible investing. Benefits of socially responsible investing: aligning investments with personal values. SRI empowers individuals to invest in causes they care about, such as combating climate change, supporting underprivileged communities, or promoting gender equality. Long-term resilience. Companies that prioritize ESG factors are often better equipped to handle risks, such as regulatory changes or public backlash, ensuring long-term stability and performance. Positive social and environmental impact. By directing capital toward ethical companies, SRI investors help drive innovation and progress in crucial areas like renewable energy, healthcare, and education. Enhanced risk management. Firms with strong ESG practices typically maintain higher transparency and ethical standards, reducing the likelihood of scandals or litigation that can hurt investors. Challenges and criticisms of socially responsible investing. Lack of standardization. One of the biggest challenges in SRI is the lack of universal standards for measuring ESG criteria. Ratings can vary significantly between providers, leading to confusion and inconsistent evaluations. Greenwashing. Some companies or funds engage in greenwashing, exaggerating their commitment to ESG principles to attract investors. This makes it critical for investors to conduct thorough research. Potential for lower diversification. By excluding certain industries or sectors, SRI portfolios may be less diversified than traditional portfolios, potentially increasing risk during market downturns. Balancing returns and impact. While many SRI funds deliver competitive returns, there's a perception that focusing on ethical criteria might limit opportunities for higher profits. How to get started with socially responsible investing. Define your values and goals. Start by identifying the issues that matter most to you. Are you passionate about combating climate change, promoting diversity, or supporting ethical governance? Your values will guide your investment choices. Research SRI funds. Explore funds that align with your values. Many financial institutions offer ESG-focused ETFs and mutual funds that cater to a variety of ethical preferences. Use ESG ratings and tools. Leverage tools like MSCI ESG ratings or Morningstar Sustainability Ratings to evaluate a company or fund's ESG performance. Diversify your portfolio. Ensure your portfolio includes a mix of asset classes and sectors to balance risk while staying aligned with your values. Stay engaged. Monitor your investments and stay informed about the companies and funds in your portfolio. Consider participating in shareholder activism to further advocate for the causes you support. The future of socially responsible investing. The demand for socially responsible investing is set to grow as global challenges intensify and younger, values-driven generations gain wealth. Innovations in technology, such as blockchain, are also enabling greater transparency in ESG reporting, making it easier for investors to make informed decisions. Additionally, increasing regulatory oversight may help standardize ESG criteria, reducing greenwashing and boosting confidence in the SRI. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.